Welcome back, friends. Apologize for taking a week off. Um, Anniversary week. Mrs. Parker is not that interested in getting up early, and she should participate in spaces. And she knows a lot about trading, of course. She agrees with me on trading, so she wouldn't add very much. Now, glad to be back. It's been a very busy couple of weeks here, and we can get into all of that as well. Um, Reversal of trends. This is what happens. Um, and maybe it's been such a long time as well since we've had a period this bad, let's say since 2020, and then, but it still doesn't make it feel better. And especially, I think I feel a little bit worse when it all happens at one time. If these markets kind of rotated, got out of some currencies, then got out of some bonds a couple months later, stocks and commodities would feel better, but we're getting hammered. And but usually, what can happen in these periods is that it's a precursor for better markets, more trends, the next stage. So we'll see what happens. Richard, hopefully, he is going to join us because he wrote some good tweets within the past 24 hours concerning this period and what we can learn from it. So that would be helpful to at least walk away with some learning. All right, we'll get Oleg connected here, and he can start us off as usual. He never misses, unlike me. He's always ready to go. Oleg, are you ready?
Yes, of course, I'm also always ready, and I'm very happy, of course, about it. And it's nice spring here in my place, and I thought today I was walking in the forest, and I was thinking that in under almost all circumstances, every weather, I feel very happy because I know it's Friday. I'm a trend follower. Today I will take part in this wonderful discussion. This week, by the way, I like such weeks, such month when performing trend following performs not so well because I notice that I think a lot more about trend following, about my system. It makes me stronger, I think, and I even like this. I like to think about the markets, and I trade for 16 years, and still every day I think, this, like how wonderful it is, how I'm happy because of this, how wonderful trend following is, and maybe in all aspects of our life. Often I give some advices to people, and they say, "Oh, how do you know this?" And I say, "Because I'm a trend following trader, and we have such principles that are very universal." And I give people advices in different circumstances, not finance even, using trend following trading ideology. So trend following is really very great.
So I was listening to some of these great podcasts from Neil's Top Traders Unplugged. I particularly liked a few this week. Winton, the Winton guy, he was very, very interesting. Um, and of course, I tweeted everything that I agreed with. I did tweet the part about him saying that David Harding is the preeminent trend follower today. So that's pretty interesting. Thought that was kind of funny. Um, and So I asked ChatGPT, of course, who is the preeminent trend follower, and definitely David was not mentioned as the most preeminent, but he was mentioned in the group, along with a lot of obvious people. So, and then when I ask ChatGPT questions, sometimes I'll go back and reword it just slightly. It'll give me a completely different answer. So hopefully the newer versions will eliminate that because I get a little confused if you word it just so you get different Okay, enough of that. Um, Seth, what's up?
Hey, good morning. Um, what's up? I got kicked out of my 2-year yield bond position yesterday and had a new long entry in Ethereum futures. So that's kind of exciting. It seems like both Bitcoin and Ethereum have been kind of bucking the risk on, risk off trend and are trying to break out with stocks going down. So I think that's pretty interesting happening right now.
Yeah, I like that because I trade both of those, so I got long a little bit. Going to add to it if the other systems kick in. Not pyramiding, but because all my systems act independently, they don't know the other ones exist. They have a proportionate level of the AUM and they act on their own. So I don't think that the signal's getting stronger or anything like that. All that nonsense. It's just the different systems are kicking in. And so I entered, and I was amazed by that too. I'm looking for signs. Like I would see that Bitcoin, during over the weekend or at night is up $1,000, and I was like, okay, this means something for the stocks or something for the bonds, and I don't think it really did. So that was pretty fun to get long those things. And then I added a couple of crypto stocks, I guess, crypto stocks or blockchain stocks. There's not that many pure plays left that are very liquid. So there's a couple out there. I got long one of those. I shouldn't name the stock, but yeah. So I thought that's a very interesting little development here. Kind of more fun. I've been flat those things for a long time. I didn't do the shorts because the vol was too high. But yeah, I've done well in crypto, in the Bitcoin and Ethereum, and adding some of those stocks to give me a little bit of diversification. Too bad I wasn't short block. I guess is that considered a crypto stock?
Yeah, I would say so. That's the or is it Block is the parent company of Square, right? The payment company. I haven't really educated myself too much on crypto stocks. I guess Coinbase would be the kind of big one that everybody would know, and maybe Riot blockchain, which I think is like a miner that's publicly traded. But I know Coinbase hasn't been doing so well or as well as Bitcoin and Ethereum. So maybe Moritz has some good info on that, being that he is the pro in that field.
Seth, I'm not the pro. I'm never the pro in anything. But I think you're right. Block is the parent company of Square, the payment service provider. So I probably wouldn't put that into the blockchain equity type group. And I can only guess that Coinbase has been underperforming. If you say it has, I actually didn't have a look because they have received a Wells notice from the SEC on their I think yield farming type of products. So I guess that's not a good sign. But I don't trade Coinbase. There's a couple of people that get excited about the Coinbase bonds, which again I don't trade, but they do have bonds. I think out to 28, 2029, 2030 even, and they have fantastic yields. So people trade these. I don't. I'm just looking at my system, and like you guys said, I mean, the last couple of days have been a little bit tougher than usual, and I got kicked out of the 2 year, as did you, Seth. But I'm still short the 10 year. I'm still short bubble. I'm still short most of the bonds. I think I got kicked out of the 3 year Aussie bond, some Canadian bank bills, but that's about it. I opened a short in MSCI emerging markets, and of course, that immediately went against me. So, really not given the volatility that happened in the market. I was kind of like thinking that probably there's there should be more happening, or there could be more happening at the portfolio level with more positions being taken out and new positions being entered into. But it wasn't all too much. It's just showing a drawdown, showing a significant loss for these couple of days, which comes out of the fixed income sector, and boom, there we are. So, goes down, and then usually over the next coming month we'll make it back. Fingers crossed. Hopefully it doesn't take too long.
I want to say, Moritz, I get remembered right now your words that don't be upset. I don't remember exactly, but you have said one of the episodes of Top Traders Unplugged a year ago, no, 2 years ago, I think. Don't be upset about one particular trade or few trades, because if we are trend followers and our system is perfect, so if we have, and I'm saying myself now, but it's our philosophy that if we have proper risk management, wide diversification, there is nothing to worry about. I think it's first of all we are trend followers, and few trades, so maybe 1 month, it's nothing bad with it.
I do agree with you. I'm not. Look, we live and die by the sword. At least I do. So I'm, not kicking any rules out of the window or stuff like that. It's just the the moves that we've seen in these bond futures. I mean, I've never seen anything like it. Not even in the financial crisis. Like, people told me that when Lehman went bust, like on that day, or kind of like the days around that, like the kind of euro-dollar contract moved 30 basis points, right? Something like that. And that was like the extreme. And last week we had like, it does move 30, and then the next day it moves 80. And you go like, wow. I mean, this is really just amazing moves. But, like you say, I stay steadfast and, trade the system. And the next day when it tells me to go short MSCI emerging markets, then that's what I do. Just click the mouse and do it. And again, like, we've said this before, like when you have these days and these maybe weeks and months where it's a little bit rough and rocky, that's exactly the point in time when I think you need to put your mind in a position where you remember the other days as well, where, it's kind of like really nice and you're so happy about that trading strategy, and you just know that you'll get back there, and life's good, and therefore, even if the day's down, life's still good, and you shouldn't be grumpy about it. Yeah, maybe a little bit grumpy, but you know what I mean. Don't freak out.
Yes, I agree with you absolutely, and I get remembered a lot. I have said this before, that now I'm listening the episodes that was in spring in 2020, and I remember, and in fact, you, Jerry, Moritz, and Niels, you gave the guys.
Did you guys hear me? I'm not sure. Maybe I have issues.
Yes. No, I hear you.
Again.
And
Yes.
do you hear me? I also often, maybe recent 5 our episodes have problems with. Okay, so Moritz, you have it was perfect guide of Jerry, Moritz, and Niels in the times of this Corona crisis. It was really very perfect what to do to the people, and it was a very big gift to the world that people get known, get information to understand what is going on before this crisis. You, Jerry, Niels, and Moritz said that we must be broadly diversified before the crisis. Before the crisis, it was the perfect instruction what to do. And in crisis period, so it's very big gift for the world. I have said this before. This episodes of Top Traders, Systematic Investor.
I want to set up Richard because I was really interested in some of the things that he was tweeting about yesterday about learning lessons from this period. And another thing he brought up was a very nice sentence was the back test got us into this problem. I thought that was really good. It sounded like something I certainly wish I would have said. That's a Jerry statement. And so it's the opposite of what most people would say. But I think one of the things that one of the points he was trying to make was that, I sort of understand this very well after 39 years of trading. But it was this idea that we have all this diversification and we get lulled into this situation where, I don't really have to worry like others who trade stocks only or long only stocks because I have currencies, commodities, stocks, bonds, long, short, crypto, and stop losses. Trailing stop losses. And I'm limiting my losses and I've got these trailing stops. And so then you have all of this correlation happen, and the portfolio is sort of built on the idea that you're not going to have this correlation happen in extreme ways all at the same time. Maybe it's buried in the data somewhere. You basically don't even really notice it. It's very painful when it happens in real life. And I think that that's so true. And it's kind of interesting that probably for the stock people, when they do their analysis, their back test, they never see this. It's always correlation. It's always very, very close to the max. And so we get lulled into it because we're like, we don't have to worry about that as much. But I do think that I don't want to be in a situation, and I don't think I am in a situation where I'm learning a lot. I don't really want to learn a lot from this. This is not where you want to be. Maybe we're there and we're always going to be here and there, where we're having these good periods and extremely bad periods where we're actually learning something. I don't want to learn anything. I want to come in on day one and have my max risk budget where it should be based upon survivability and my personality, let's say. I want to have a lot of diversification, robust systems, longs and shorts, taking small losses and letting profits run. I want to have my act together before, and then I'm going to come in every day assuming all hell can break loose. I don't need to see it again. And this is not the first time all hell has broken loose. And I don't think I really did anything. I traded smaller, and that's usually been my problem, is that my root problem is every now and then I will realize that I need to trade smaller. And I could have done that on day one and never changed and realized what I could handle. But I don't think, and maybe I'll have to keep learning that over and over. But as far as these particular markets, golly, I really hope I'm not at a stage where I need to learn something. But this is exactly the thing that the guy from Winton said as well. He was making a big deal about that, of trying to identify situations like this or other situations that have happened before and learn from them. And his idea was really not a part of trend following. It was, we're going to analyze the fundamentals and the markets and the correlations on what could happen. And since we've seen it before, we know it can happen. I'd prefer to not only learn from the things that have happened, but it's basically a million different things, and it's going to be a million different things in the future. It's just going to cause me to have high volatility and lose money. So that is going to trigger my rule. I don't want it to be triggered by a fundamental. And of course, we also have I left out a very important part for me. The reason I can have a prayer to have my risk under control is because I use my realized balance as my trade level. And I'm instantly and always more on the conservative side. And then I have my cutback rule that if I get into a situation where I'm losing a lot of money very quickly and I'm getting close to violating my realized equity level, then I can just reduce positions by 20%, 40%, 60%, whatever that number is. So I feel like I want to come in, I feel like I do come in every day with my act together and not really needing to get a tremendous spanking from the markets in order to, oh, now I get it. For heaven's sakes, I should get it by now. Whatever it is, it's causing me to lose money. And what am I going to do? And why don't I have rules in place to mitigate that? And if we get so freaked out, we'll just trade so small, it won't be even worth it. So, okay, there's my diatribe.
I fully agree with you. I like this very much, and I want to add that Niels said that we always have a clear plan. And I like this words of Niels. Also, we systematic traders always have a clear plan. And also, we are based on universal rules. So, really, as I have wrote in my Twitter, that the main lesson for me is that classical trend following trading is the best way of managing money in all crises. And all crises are good reminders for us. All crises in history are good reminders for us that classical trend following is the safest way of managing money, the best way. I see it over and over again every crisis. So I'm very confident in this strategy.
G'day, Jerry. G'day, everyone. Great to be here. Yeah, look, I tend to think that we can learn something from these events. Now, what I mean by this is that if we find that, I think that these events in March are going to reveal trend-following portfolios that were perhaps aggressively diversified into bonds. So, you know, for programs that have experienced a month-to-date result of, you know, down 14%, I think Aspect sitting in there. I think Trends up in double digits now. I personally think that there are certain trend following portfolios that have had very limited impact from these events. So I do think there is things we can learn from here. Because we've also learnt from them in March 2020, and we also learnt from them in Volmageddon in 2018. And that is this quest, I believe, that we should be following to search for uncorrelated markets and uncorrelated systems. Because I think if you do get into those double-digit events from applying a trend-following process, that to me tells me you've got a problem in that your drawdowns are too rapid in extent. And this is a feature of what I think is too much correlation as opposed to other factors. There could be too much leverage in there as well. But I think correlation and leverage will be the reasons. And also, when I say reliance on a backtest, I believe that the bond markets have been particularly favourable for trend-following portfolios for the last couple of decades, to be honest with you. And I think that this favourable bond environment for trend following has therefore meant that a lot of the trend following programs that place a lot of reliance on backtests will find that they naturally will load up on bonds or bond correlated assets, which led them into this sort of situation. So I think there's certainly things we should learn from these events in that if you do find that you're in double digits of 14, 15%, you clearly don't want that. And there are, you know, what that forces you to do is have a good look at your diversified portfolio and see whether it is actually as uncorrelated as you assume it is. A very good thing in Winton, I think, was this comment made regarding the traditional markets that a lot of trend followers are invested in, these 50 or 60 traditional liquid markets. They are very highly correlated. And therefore, efforts to invest in alternative markets and efforts to invest in uncorrelated systems and efforts to invest in perhaps synthetic markets are ways to reduce that degree of correlation in the traditional markets that we may be facing today. So, you know, that's a lesson, you know, if we find that, you know, in any particular month, our drawdowns are far too rapid, which means that because we do cut losses short, some of them who haven't been applying stops, of course, might find that their losses have been quite significant this month, like TransTrend. But those that do apply stops, and cut losses short. The reasons for this poor performance is because their portfolios are too highly correlated. So I tend to think that there is a lot of learning we can do there, and I tend to think that you do need to adapt your systems over time. And with this additional data set from this regime that we haven't experienced over the last 20 years or whatever that we found ourselves in March, once that goes into the data set, it naturally is going to have an impact on adjusting to a degree or adapting the portfolio to not come into that situation again. Because if you're continually victim to these mistakes associated with correction where you're too highly correlated, I think, if you learn nothing from them and you continuously do those mistakes, I don't think there's much excuse when you're talking to your investors about, what efforts you took to, mitigate the risks that you've clearly seen happen multiple times before, but appears you're doing nothing about.
Yeah, yeah, I agree with all of that. It is interesting that the vol management, correlation management did not kick in a way that, or maybe it did, and it would have been a lot worse. But yeah, I think that's another thing too. I just glossed over, and that is you've got to come in with more diversification. There is not a lot of diversification in those bonds at all, really. There's some, certainly not on bad days. The P&L on each one of those short trades is going to be a bit different, of course. Some of them were better, and some of them are still near the lows, and some of them are, like they were saying earlier, the 2-year can be along now. But it really does point out to another question so once I try my best, even though I have a lot of these correlated markets and the stocks and the bonds and the currencies, and then I get my max risk where I think it should be, and I get as much diversification as possible. I'm not going to be one of these people who overload on the bonds, and thus, it's one of the greatest years in trend following history, mainly because of the bonds, I think. But I'm going to trade all of these markets, and when people question me, I'm going to say, well, yes, I'm trying to get as much diversification as possible. I'm not overloading in any sector or markets, but honestly, I'm going to kind of sit there and absorb a bit of this correlation because I'm hunting for outliers. And I think that we keep coming back to this. And so someone could say, maybe not as an excuse of overtrading the bond sector, but they could definitely say that, well, I'm not going to be as concerned. I'm not going to trade, a few grains, a few metals, a few energies, the softs, and then 4 or 5 currencies and 3 or 4 bonds and, a couple of stock indexes. I'm not going to do that to get this more diversified portfolio, because that's exactly what you would have to do to optimize on the number of markets, and it would be heavily commodities, and then just say, well, that's what I'm going to do because everything else is highly correlated. We don't want to do that because then our comeback is, well, that is true, but as outlier hunters, we need to accept a certain level of correlation, over correlation, because hidden in that correlation is going to be a time when the heating oil doubles or triples and crude sits there. And then after that, they go back to being 90% correlated.
Oh, I think that what you just said everyone lines up perfectly with trend following and what we're going through now, which is drawdowns suck and absolute returns rule. That's what we live for, that absolute returns and outliers go hand in hand.
Yeah, Brian, I'm with you. And I think there is a bit of confusion when people assume that getting a good sharp in their program is delivering absolute returns, because I think you can do more than that, because we see the weakness of sharp with beneficial volatility, and that's not being addressed. So, of course, trend following is always going to be penalised if we're using something like sharp as our measure or our metric for performance. because I think that the penalty applied to beneficial volatility, such as the step-ups in outliers, is significant, and it immediately therefore favours multi-strat programs as opposed to trend-following programs to include in your portfolio. And there's a lot on that we can say, and also correlations. I think we can address to a large degree through system ensembles, which I've wrote about before in my tweets. I think as outlier hunters, there's certain things we can do. If, for instance, we find that we are trading markets that have a tendency to be fairly highly correlated, we can break down that level of correlation with system ensembles. And I think that's a necessary tool that we include in our armory of diversification, not just market diversification, but system diversification as well.
And the drawdown from a big profit is not the same as is more tolerable and more okay than a drawdown from other drawdowns, possibly. I really like this quote from the guy from Simon from Winton. I'm going to read this tweet, but I'm confused, and maybe someone can clear this up for me. A strange confusion affects CTAs, particularly, equating risk with volatility. When asked about their risk level, CTAs will often reply with their volatility level. And it can start to feel natural almost, but when you step outside of this for a moment, it's totally bizarre. And as I've said before, he says it probably comes from the fact that actually estimating the risk of loss, which is what everyone cares about, is incredibly hard. Whereas the problem of estimating your current volatility is relatively easy. Yeah, it's on the performance table, so let's grab it. And that's the magic formula. So I guess what I like that he said that, of course. But then he goes on for the rest of the podcast, and in almost every other sentence he mentions Sharp. And we do this for Sharp, and Sharp is this, and we need to increase Sharp. And so I was really confused as how he was, another good Jerry quote, it's totally bizarre to use volatility as risk. But then he continues to talk about how he does use Sharp. So what am I missing there?
Well, I had a couple of listens to this because it's a very good podcast. And look, I probably agreed with half of it and I disagreed with half of it. But the half that I did agree with, I strongly agreed with. And that quote that you mentioned from Simon, I think was a fantastic quote. That's an argument we've been saying many times on this Spaces podcast, that do not confuse risk with volatility. And that's effectively what he's saying. So that we've also got to be careful ourselves, because I've slipped into this habit myself. When people say, what's your risk? I might throw out, my standard deviation is this, and I'm falling into that same trap. So I think we've got to avoid that talk, because trends by their very nature are fairly unpredictable. Outliers are definitely unpredictable. And to equate volatility as a necessary accompaniment to hunting outliers, but it doesn't mean that we shouldn't be seeking uncorrelated return streams. We should, but we should be seeking maximum diversification with uncorrelated return streams. And that will also achieve that objective we're looking at, is maximum diversification in our hunt for outliers. And by virtue of the fact that we are targeting uncorrelated return streams, it means that ideally, when we do find that we get those outliers, they're not all clustered together. They're distributed throughout the return stream. And that's ideally what we're seeking, because we would like to have this equity curve influenced by these outliers along the entire course of time, rather than being clustered in locales like 2008, 2014, 2022. We want it as distributed as much throughout. And to do that, we do need to look at uncorrelated return streams to achieve that objective. But what Simon was talking about, I think the half that I didn't like of Simon was where they're accepting their role as a CTA, very much like many of the other CTAs that we've heard on Niels's podcast, where they're basically looking to the needs of the investor and what the client wants. This is something that I certainly don't do in my world because, I don't have to service the needs of clients. So I'm looking for absolute returns with maximum diversification for my portfolio. But when you're dealing with clients and clients' objectives, that's where the business of CTAs comes into play. And, if they've got a portfolio that's heavily dependent on equities, then, of course, Winton would say, well, attach this particular program to that to get a better Sharpe. But that's really talking in terms of satisfying the needs of the investor in that the investor doesn't want to find that they come into a program, fully invested into a program, and find that they immediately enter a drawdown. So he was suggesting that, there are particular offerings that they have at Winton where, they can help to improve the Sharpe, but also to sort of, progressively average into trend following through these techniques, as opposed to getting involved right from the get-go with a maximum allocation, but just progressively step into it as a way to prevent this impact, which is negative to a client where they invest in trend following and they find they immediately enter a drawdown. So some things I agreed with, some things I didn't, but yeah.
Richard, sorry, can I ask you something? At one time, I talked to you and I said that what I used the Sharpe ratio just as an approximation on considering how a trend following manager changed in his history. For example, we were speaking about TransTrend. TransTrend has low volatility, but if you see the chart of its volatility, it's horizontal, right? I mean, it didn't change. On the other side, you have Winton, which started with a huge 20-25% volatility, and then it dropped and dropped and dropped, mainly, I guess, because of what you said, because they are catering to clients, and the clients, when they allocate, they want a low volatility, something more predictable. That's why they do volatility control and correlation control, etc. I was using that, just to consider, because if you, for example, say, I want a 20% trend following slot in my portfolio, and then what you bought is now a very different thing because it deleveraged, so to speak. Now you have a problem. And I'm always considering something else. Do you think there is something better to do that? Do you think it's worthless? Do you think that, for example, looking at the average drawdown is better? I don't know if you understand what I mean. Sorry.
Look, I sort of come from the perspective that I'm obviously very, addicted to this trend following. So I'd initially start from a stance of 100% trend following is best for my client. But if a client comes to me with a significant investment in equities or whatever, what I'd do is, rather than just slap on as an appendage a trend following component of, say, 10 or 20%, what I'd do is I'd do a comprehensive assessment to identify what an optimized level of trend following would be. And that's where you'd suddenly find that it'll probably be up around 65, 70%. It's interesting that Winton, their primary trend following program, or one of their primary trend following programs, is a 75% allocation in trend. And that's sort of the figures I'm also getting. About 66% is an optimal allocation in trend when you've got a 60-40 portfolio attached to it. But rather than just slap on a token measure or a material amount of trend, you want to sort of make sure that it's a sufficient allocation, as opposed to something that's just a little guess.
No, yeah, that's right. That's why, for example, if you see, I don't know, the Mulvaney curve, you will see that it's always the same. If you look at it in terms of return, standard deviation, or drawdown. So if you bought 20 years ago, that curve, for whatever reason, you added to a portfolio, and I agree with you that for me, trend following should get a high percentage of portfolio risk. But in any case, that didn't change. The problem is, for me, is when you allocate to one strategy and it changes because the manager deleverages or the reduced risk, reduced margin, whatever, and So I was thinking about what would be the best way to control that.
There might be someone better here to answer that for you, Cord. I don't know really how to respond to that one.
And another thing that I want, maybe this would really be a little, I don't know if boring or different, etc. But when these times come, everybody starts to talk about not only risk but danger in brokers and banks and custodians, etc. And I just wanted to know if you guys care about that at the moment. Do you guys have a plan? I know many of you have different setups. Sometimes some of you guys do contract for differences, which is a different kind of credit risk compared to, let's say, going to the CME through brokers or doing a combination of brokers and custodians for people who has lots of money. But when things like this, I was looking at what you said, Jerry, about TransTrend, and they connect that with the movement in this SVB. But whatever, I wanted to know if you guys does that take any sleep out of your nights, or you just don't care about that?
I certainly care about it. So with my particular process, I will be trading across multiple brokers. I do that for counterparty risk reasons. But in my world of CFDs, it would be different to futures. But certainly counterparty risk is a big one for me. And I just need to ensure that I'm not overly exposed to any single broker. So there's a bit of a selection process that goes into that, and some of the considerations made, and also trading multiple brokers. It allows me also to find the better, spreads and transaction costs that do exist amongst different brokers. So that's a process that sits as an overlay onto my models of execution.
Cool. I trade on futures, so I have margin on the broker, which in turn it's on the CME, and then I have extra margin there, and I'm having a very hard time to understand the whole issue of credit risk inside some of the brokers because of the rehypothecation, etc. And when these times comes, that thing always rears its head, and it's kind of complicated. And on the other hand, having a combination of custodian and broker, it's very difficult to implement because it's very consuming in terms of execution. But maybe you guys are concerned about that or not. I always think about that because that would be like the worst drawdown possible.
Yeah, something to keep in mind is that whenever we go into these awful events where trend followers prosper, that's the time usually the regulators come out with some weird rules that significantly hamper our operations. And, we found that with the nickel. We find that a lot of the cases when we're trying to go short on particular stocks here in Australia, and suddenly the regulator comes out and say you can't go short on them. So there's lots of these things that happen during those events where trend followers prosper. That tends to be times that the regulators, et cetera, come in and they certainly change the rules, which is quite frustrating. And we just got to be aware that that is something we've got to keep in mind all the time.
Good morning. Good morning. Excuse me. Good morning, Absolute. You must have something to share with us this morning, I hope.
Yeah. Hi, everybody. I don't think I have much to share. Just like last year, I was calm with the markets and performance. This year, I'm also calm, but also my performance is not. It's not as wasn't. There was no much reason for me to be happy last year, and there's no reason for me to be disappointed this year. That's also part of the strategy as designed. How I've designed my strategy is to have the positions on exactly as I would want them, at the size that I want them, to reflect my view of the world on this planet at this moment, given the data provided to it. So in that sense, I've become almost immune to P&L because I know that with the data that's come in, that's causing the positive or negative P&L, the fresh data that's coming over the last few days or last few weeks has adapted my portfolio to reflect that reality, and that is as good as I can be and as good as I can get, and I cannot do any better at any moment in time. So there's no reason for me to do anything else. I just trust that the strategy is adapting its view to reality as reality changes, and the method by which it's doing, I trust, and that's all I can do. I honestly don't even know what my current positions are in each particular market. I haven't even looked at sectors exposure, like currencies, dollar, or interest rates, or whatever. That's how disinterested I am, and that's how much I trust the process. In terms of some of the comments I heard today, and I have to say, I haven't really listened to Top Traders Unplugged for the last couple of weeks. And also, I don't know if you also noticed this with Twitter, but what is it doing to the curating of my timeline? I'm not getting anything from like Jerry or from Richard or from any of you guys. I'm not getting anything in my timeline. Like if I want to see somebody's timeline, I have to actually specifically search for Jerry or Richard and then go to their timelines. And then I see, oh, these guys have had a discussion or something has been happening. So I don't know what's happening with Twitter, but it looks broken to me. And regarding some of the comments about the difference between risk and volatility, like what Jerry just commented. Yes, volatility is not risk if you split your assets into realized equity, closed trade equity, and open profits. So, so let's say you have 100 million and 50 million of which is, and this is also, I gave this example to Jerry maybe a couple of weeks ago. We exchanged few private messages about this subject. So if you have 100 million AUM, 50 million of which is realized equity and 50 million of which is open profits in the form of distance to the trailing stops. So in the sense, yeah, you now have 100 million value. The value of a portfolio is 100 million. But if all your trailing stops and stops get hit, you would lose 50 million and then you will just have the 50 million that's realized. So, so if this 50 million that's open profits fluctuates a lot, 10 million a day. So you're up 16 or you're up 40, but you're up, you're in profits. That's huge volatility. But the argument is that such volatility means nothing about risk because your risk was controlled when you entered these trades 2 years ago with tight stop losses. So you entered all these trades a couple of years ago. You have 50 million in open profits in concentrated bets in few markets or a sector that is now very volatile, and your positions are big. And you're very volatile. Your $100 million portfolio fluctuates a lot in percentage sense. It's very volatile, but you're saying, no, it's volatile, but I'm controlling risk tightly because I have tight stop losses on my realized capital, which is sitting down there at 50 million. So don't bother with this, millions of dollars of volatility and percentage volatility today. It's all with open profits on trades that I entered 2 years ago. So please don't bother with it. Just, smooth sailing. Your initial 50 million is safe. I am volatile, but I'm not risky. So the argument to separate volatility and risk can only be done when you separate realized equity, which you watch tightly with tight stop losses, from open trade equity or from total equity. When you make that separation, you can separate volatility from risk. If, however, you value all dollars equally, if you value all your $100 million equally, which, by the way, you have right now. If you close your portfolio right now, you will have $100 million. You have that money. Whether half of it is realized and half of it is open, because half of it is reflected in trades that you entered 2 years ago, the markets don't care. The markets don't care when you enter the trade, whether you entered it today, last month, last year, or 2 years ago. The market is the market, and your portfolio is reflecting your relationship with that market, whether you want it or not. You can call these dollars realized dollars, you can call these open dollars, and call them differently. However, from accounting perspective, and I think Jerry and Richard have accounting background, from accounting perspective, a dollar is a dollar. So when I was making an argument in Jerry's message, when he asked me, what do you mean by efficient allocation of capital? So my argument about where this thinking is wrong, and I appreciate it, by the way. I will have to make a disclaimer, and I've made this disclaimer many times before. I respect Jerry's approach and Richard's approach highly. I really like it. I hadn't looked at it before. I mean, I knew how things were done, but as Jerry explained it, it's philosophically very solid. It's a solid view of the world, and there's nothing wrong with it. However, my argument against it is that it doesn't use capital efficiently. My argument is that keeping those $50 in open profits in few concentrated bets does not allocate your capital efficiently across your total ensemble of markets and strategies. So just because...
Let me
Okay.
comment, because that's really good stuff. And you won't forget what you want to say after what I say, whereas I might forget. But okay, that's very eloquent. I mean, I can put you in charge of my marketing because you did a really great job, and that's exactly correct. Now, one of the things that I would say to that is that I think one area where you're missing is that by creating it this way, the way that you explained it and the way that we do it, what you left out is that it makes the most amount of money. And doing it this particular way, we maximize the amount of money that we can make. And then another thing, of course, is that we trade each market a bit larger based upon, looking at the back test. We trade each trade larger because we're taking away some positions and contracts and shares due to the using realized balance. So the only way that you can make more money than doing it our way is, and this is what they do every single time, you must introduce risk-adjusted returns. You must. And of course, you must introduce it with their definition of risk-adjusted returns, not capital loss like the guy from Winton. Well, he said it. I don't think he means it. But the only thing that matters is how much money am I going to lose? And that's difficult to calculate versus volatility and Sharp are staring you in the face. All you got to do is look at the performance track record. So we're going to trade a bit larger, and we're more concerned with that open trade and maximizing that open trade than anyone. We take a no back seat to anyone. We are the number one traders more concerned about that open trade profit because we have come up with a method that allows us to handle it the most perfect, and that is following the system. And the system does not need to be adjusted suboptimally. By definition, if it's adjusted, it's suboptimal in order for risk concerns because we have the risk under control. And so another thing too, I think you're going to get into this because I still don't really understand about this efficiency thing. Because another thing too is there is not a trade that comes along that I don't take. So whenever a breakout occurs, I'm going to take it. So my money management not only doesn't prevent me from efficiently using my capital and taking on new markets and new trades, it allows me to do that. Please go ahead.
Okay. Yes. So you made those points in the discussion we had, and those are good points, and they're valid points. What my response to that was, I think, if I remember, well, I think what my response to that is that, and I'll respond to those before, but ultimately the strongest response to this doesn't address those issues individually, but the strongest response to what you just said is that to your claim that you are taking care of the open trades very carefully and that you're only doing it in order to maximize and that you do not agree that you're not using capital efficiently. You think that this is the most efficient way to use the capital you're being given, whether the capital is being given by investors or the capital is being given by the markets. So I see the first 50 million, the realized 50 million is money given cash with your investors, from your investors, or money that you've taken from the markets that's realized. And the second one is one that's being handed to you by the markets, but you still have refused to receive it as yours. But all those money, the whole 100 million is given to you at all times to do whatever you want with it. You're just saying, I will treat the first 50 million one way, I'll treat the other 50 million the other way. And for me, the proof that the ultimate proof that you too agree with me that this is inefficient use of capital is assume a scenario in which your strategy is where it is now, with all the positions as they are now, but assume that you are now entering your strategy, where you have now you're entering the strategy, or assume you have 50 million in realized capital and you would have had these open positions with 50 million open profits, but they're not there. They're not there. So hypothetically, they're not there, but your strategy would have been in these concentrated bets, entered 2 years ago, hypothetically. And a new investor comes in with $50 million more. So you have 50 million in realized cash. A new investor comes in with 50, and then it says, okay, trade this money. So the 50 million in this case is handed to you in cash by investors or with your own money. Whereas in the previous scenario, the 50 million was handed to you by the markets in the form of open profits. And I think we already discussed this. The fact that you would not put the fresh 50 million cash in the concentrated bets, risk them in the few concentrated bets that would have been entered 2 years ago, whereas you would just sit and wait for new trades to enter. You wouldn't put them in. Is proof that you also agree that the 50 million in the open profits today entered in trades from 2 years ago are using your capital inefficiently.
No,
for me,
but that's a misunderstanding because I think that I'm not doubting that my answer was not what you say it is, but it was in a different context. So, no, obviously, I would put those trades on. Now, in a more realistic, I mean, it has nothing to do with the system per se. I mean, I would put them on.
but Jared, it does have to do with the system. The system says you should have these positions on.
Right. Yeah, but that's what I'm saying. The system says I should have them on. So if I didn't put them on, it's not due to me not believing that they should be on in a perfect world. But I think when I'm usually asked this question, it's in the context of if you're managing $1 billion and you're up 50% on the year, and with a lot of open trades, and someone says, I'm going to put 50 million in your fund, what do you do? I mean, you have no choice but to absorb that 50 million and put all those positions on. It's a legal thing. Now, if it was a managed account, and the person said, I know you're up a lot on the year, I want to open up a managed account, and here's 50 million, I would suggest exactly what I think Richard disagreed with, which is, I tell you what, give me 10 million a month for 5 months. I want to try to do something here as a businessman to make your experience not so risky here. Because if I draw down 25%, all of my other clients are still up 25%. But since you have this managed account and it is yours only, and you're not part of a fund, where I would be under every obligation to give you a pro rata piece, then people ask me all the time, how do you nuance this? And I've had to deal with this over the years, and if there's no really good answer. But in a mutual fund or a private fund or an ETF, yeah, you would just throw those positions on. Here's the problem, and that is that it goes right back to something I said earlier that I fundamentally agree with, which is a drawdown on open trades is much different than a drawdown on the capital. It could be much larger on an open trade and much smaller on the capital, but the capital one would be worse. And that's because you have that built-in profit. But you don't have the built-in profit if you give me $50 million today. And so I'm like, yeah, I know you want to make the same P&L daily, which is, I'm required to give you that. But it's really going to be probably tough sledding for a while. And I've done the opposite. In 2020, people were trying to give me money. I was up 25%. And I said, hold on. And they didn't invest in 2020. Then 2021, I was up another 20%. And I kept saying, hold on, don't invest yet. So, I have this fear of people getting in and having a bad performance, but, you can't predict these future returns. So I gave you the false impression that I wouldn't allocate to that, but because it's just a business decision of trying to take care of your clients.
Okay, that makes sense. But what my point is that why not build a strategy that always reflects your view towards the world at all times, so you don't have this problem anymore? With such a strategy, all your dollars are equally valued, open, closed, or whatever, and all your capital is always optimally allocated across your whole ensemble of markets and strategies, the whole two-dimensional matrix at all times. So you're basically, your goal is to always expose all your capital where is it most efficiently used. And your capital is most efficiently used when spread out across your whole ensemble of markets and strategies. Whenever there is a high concentration of your capital, for whatever reason, and in your case, the reason is your commitment to holding on trades from 2 years ago. You entered few trades few years ago. Now you have a huge allocation. You have 50 million out of your 100 million allocated in just few dots on this two-dimensional matrix of markets and systems. And you yourself know, and everybody knows, that allocating huge chunks, half of your AUM, to few concentrated pixels on this two-dimensional matrix is suboptimal. Whereas you have built a strategy, and I've built a strategy, that I know that for every new dollar that I'm being given, either by extra cash or from investors or from the markets, every extra dollar is best spread out through the whole ensemble at all times. That's where its return to risk ratio is maximized. The return to risk ratio is not maximized when you have huge chunks of your AUM concentrated in few pieces of this two-dimensional market strategy ensemble. Does this argument make sense?
Well, all I can say is that you just need to think of it as an algorithm that you can't even see. and just be amazed at how can this thing make so much money, and why do they seem to be playing outside of the rules, whereas you said we are cheating, and the volatility is not an indication of our risk of ruin and our ability to stay in the game. And so by using this funky algorithm and the way we do it, we're able to, number one, follow the system. Number two, I always forget to say this, but this could be one of the most fundamental points. We're able to trade with strategies that have less parameters and higher sample size. And we cannot handle the trade better, as you eloquently said. I mean, the first thing that you were saying earlier about how you are approaching these markets, that was just beautiful. And that's exactly the same thing. I'm trying to quote you, you're not going to do better than the system. And that's exactly what we're saying. We're not going to do better. You can criticize, you must bring in this risk adjusted that you just brought in. That's what I'm saying. You must bring it in. Although, by your own admission, we're not subject to vol. So you cannot improve upon your system by adding other things to it, and especially frequently reducing positions due to increased risk. That's just something we should try to stay away from, even though I advocate doing it in extreme situations. Anyways, I kind of lost my train of thought. Richard, do you want to weigh in on this?
Look, I suppose I hear both points of view, and of course, Jerry, I'm in your camp. And this is the reason, because we treat realised balance differently to equity. I think what you'll find, if you compare us to other trend following programs, etc., what we're prepared to do is we are prepared to hit it out of the ballpark with our unrealised equity. And that's where there's this big difference. And Absolute's right, because what happens is we never know when these outliers are going to occur, but when we are riding an outlier, we are prepared to commit all of that unrealised equity to it, which can lead to incredible amounts of unrealised equity. But that is part of the game of trying to hit it out of the ballpark. Other programs that treat all equity the same, they'll say that's far too much concentrated risk to apply to a single market. We need to take off some of that risk and spread it more evenly throughout the portfolio. And the reason for that's logical, because they're using total equity as their measure. We're using realised balance. We don't care about this notion called unrealised equity, because that's our gambling money. And when I do review some of the best traders in the world, like Soros and people like that, I notice that what they do is when they are on a winning trade, they're prepared to commit to that winning trade. And I think that's what our hunt for outliers does. It means that whilst we never know when these outliers occur, when we are riding one, we are prepared to commit everything to it, because we never know how long they're going to go and what their magnitude is going to be. But with a massive bet, that could be the windfall that is the fantastic trade of the year, or 2 years, 10 years, or whatever. And so it's just the way we bat, and it's the way we play our game, and we go for these home runs. And I think that other methods, they're not going for the home runs that we are. What they're doing is they're saying, right, there's an edge in these markets which is much more predictable. It's much more continuous in nature, much more distributed throughout the market data. We'll go for that form of edge. What we're saying is, well, okay, we recognise that these alternative edges exist, but we really like this particular edge where it's an all or nothing edge, where once we get our bats swinging, we go for the home runs, and we get these massive windfalls. And personally, in the long game, in the very long game, I think that one method is better than the other. I prefer our method, because I know that these transitions and these tail events are what ultimately drives the nature of change in any financial market over a period of, the long period of time. And the edges that arise from alternative methods that are looking for convergent market data, or different forms of edge, they're weaker than what the edge we deploy. So that's why I'm prepared in my philosophy to say, I'm going to go for these home runs with this particular style that treats realized balance distinctly from equity, and I'm prepared to swing my bat heavily with that unrealized equity.
Hey, hi everyone. Glad to be here. Hope you guys are all well. It's been a time since I don't talk with you, so anyways, I missed you guys. And I've got some thoughts to share here with Absolute. I know you're well trained in math. I know many guys here are as well. So I was thinking in these terms, and I propose a different perspective. You just commented that the way Jerry and Richard deal with open trade equity versus closed equity is not the most efficient way, because it doesn't value every new dollar the same. So I was thinking in these terms. Why is it better, or why do we must think in continuous terms? Why do we have to value the new extra dollar the same? Whereas if we treat dollars as our capital as chunks of capital, and think that, oh, this chunk here is dedicated to that one trade and it will develop as it should, and there's this other chunk will develop independently, and etc. I was wondering if we treat every new dollar the same, the cost of opportunity here is, the opportunity cost here is that we are giving up the ability of that chunks of money of dollars that we had. We're giving up their ability to develop as they should in a discrete way, if we treat them as open trade versus closed equity. What I mean is, or what I'm asking you is, why is it more efficient? And the other thing is that perhaps trend following shouldn't be viewed as something that's time consistent. If we begin a system today, it will develop differently than if we begin this system in a month or 2 months, because the new trades that will come up will be treated differently as the trades that should be put on weeks, months, or years ago. So perhaps we are giving up efficiency in the sense that you understand, but simply because our goal is different. And perhaps our goal, our perspective is the most efficient way is simply following the system. And the reason why we follow it is, just Jerry remembers us every time, is that this algorithm is that we find to be the most profitable one. So I've talked. I've been. I'm a little confusing here, perhaps, but I hope you get my point. So I propose you this different perspective, and would like to hear your thoughts. Absolute.
Yes, so I guess there could be different measures of efficiency. So both you and Jerry are saying that this is the most efficient way to make the most amount of money for a given risk of realized capital. I guess this is the argument. So the argument is that if I consider the 50 first, in the initial scenario that I said, where you have 100 million under management, 50 of which is realized capital and 50 of which is open profits, what you and Jerry are saying, this strategy as designed makes the most amount of money with the least amount of risk to the original 50 million. So if we assume that the capital, the true capital that we are concerned about not risking is 50, not 100, this is the best way to make the most of amount of money without risking with risking minimum amount of money of the original 50 million. Whereas the other 50 million, the open profits, you don't care so much about whether they're risks or whether they're lost or whether they're giving up altogether for a 50% total drawdown. So if you define efficiency that way, you could be making a correct claim. You may be making a correct claim. I may not disagree. Yes, that may be the best way to make the most amount of money by risking a fixed amount of realized capital. But my claim can also be true. My claim can be true. If I look at all the dollars equally, if I look all $100 million equally, my strategy makes the most amount of money by risking a fixed amount of the total $100. And if I run my strategy my way with a certain level of heat and leverage, and you run your strategy with a certain level of heat and a certain level of whatever heat you add or leverage to the portfolio, and let's see how they run over 5, 10, or 20 years, my claim and my understanding is that my strategy would make more money with a smoother equity curve, which I prefer. So that is my argument.
Exactly. And I agree with that totally. That is perfect. Now, okay, where's the punchline? The punchline is the smooth equity curve doesn't have any relationship to, well, it doesn't have as good a relationship with risk of ruin and losing your money as the way we do it. And that's what you prefer. That's what you prefer is not on the spreadsheet. That's not a back test concept. That's what I prefer. I prefer to make more money. And I think it's kind of fun that it looks like we're riskier when we're not.
Hi, guys. All right. It's nice to be here. And, this discussion is always interesting. So, so I'm a classic trend following trader, but I trade on the short term. So this means that I agree with Jerry and Richard on possibly majority of the things, but not on 100% of the things. So in terms of risk allocation, so in my trading, I use open equity, and I risk a percentage of it. And as an outlier hunter, it's very clear that I can make most money by risking from the open equity. So I don't look into the cash really. And because I'm a short-term trader, I guess the world is so my trades might last a couple of weeks, couple of days to a couple of weeks. So that's that concept of risking from realized equity is not the way to make the most of money. Definitely not. Especially on short-term trading, short-term trend trading, drawdowns are usually not the biggest of the concerns, to be honest. So it's your drawdowns are not usually as large as long-term traders anyhow. So that's number one. Number two is whether you're gonna risk fixed percentage, like $600 on each trade, or you're gonna use a fixed fractional bet. So the advantage of using a fixed fractional bet is ideally or theoretically it will allow you not to go to the risk of ruin ever, because you will continue to actually risk from your total capital. So that's why you're not supposed to go to or see the risk of ruin. So that's so I use fixed fractional bet size with this philosophy, and I risk very small, of course, using from the open equity. Now, the other conversation topic is, when Absolute was saying that what will happen if you take this money and add it into your open positions. Actually, I have traded it because I'm using Donchin channel breakouts, and my outliers is around 5% of my total trades. What happens is if I I have coded two things. I can actually enter immediately. I don't have to enter into this trade at the beginning of the trend, but I can get into the trend in the middle of the trend, right? Because Donchian channels, these channel breakouts are giving those signals all the time. Whenever there's a higher high, channel breakouts give the signal. So if I do that, my losing streak may be too higher at times. So depending on the starting point, I may end up with 30 or 40 losing streak if I'm going to do that, and that thing never happens if I start from the inception point. So that's why it matters to take the trades at the beginning of the trend rather than in the middle of the trend. So it really makes your trading better, really. And we've also discussed this correlation, right? But I think it's very important to emphasize when you're putting on trades on the same outlier with multiple systems, of course, even though these are uncorrelated systems, perhaps if all of your systems have an open trade on orange juice, and if something else happens, if a black swan event hits that orange juice trend, what's going to happen is you're going to lose all your open equity on that orange juice trend. So all of your trades are concentrated. They are not uncorrelated, but they are concentrated. So to be able to make this thing uncorrelated, you're gonna trade, for instance, if you're trading apple and orange juice, and if you have two systems, and if you have one outlier in apple, and if you have one outlier in orange juice, yeah, that works best. So long as your all trades are on the same outlier, no, that means that you're very much correlated, and you're gonna look into your total risk management from that ensemble point of view, because your risk matters. If something else happens to that orange juice, God forbid, that would be very that may be painful. And the last point is, so in terms of this, the credit risk and the allocation is, so I recently tested my systems by allocating the same amount of risk. So it's 5% equity, 5% to commodities, 5% to Forex. And really, my drawdowns are lower if I do that. Instead of actually, there could be many trades, markets among each of those asset classes, but my drawdowns are significantly lower if I am having an equal overall risk in each of those asset classes. Thanks a lot, guys.
Of course, I agree that we must be as much diversified as possible, and it's one of the main principles of trend following trading. And I want to say that when we're talking, yes, like Jerry said, that safest way, safe trading looks for investors because of a big drawdowns. I mean, from the high, they think that a drawdown from the high, it's a problem, it's unsafe, it's a danger, and these drawdowns from the high gives us the opportunity to be in the safest situation. And of course, not much people understand this. And of course, if you are in a short-term space, you have not so much drawdown from the high, not so big, but I think it's maybe the price of this, it's sacrificed in the performance. Of course, I may be wrong, but I think so.
Oh, I think another thing to take into consideration, is this idea that wherein lies your edge. So, and also the pros and cons understatement of the year, given the past couple of weeks, of compounding. So there have been times where, especially when you increase your positions due to low volatility, the volatility in a market or all the markets going lower and lower, where that is the very worst time to do that. And so I think that not only using the trade level based upon realized profits, the realized balance, does that incorporates the fear of what can happen if you use total AUM. All of those traders that are mentioned, they put on some rather large trades recently, didn't they? And because their AUM was at an all-time high prior to the past few weeks. So not only, and I keep leaving this part out, not only do I think that the trade level calculation should be based upon realized, it should also not change very often. And that becomes a problem when you make a lot of money. So sometimes the CTAs are faced with these dilemmas because they're making money. Okay, you know what? I'm going to accept that. I accept that. I like that a lot more than a dilemma that's caused by losing too much money. And so when you have to change this trade level constantly, and that's not where my edge is. My edge is the system, the entry, the exit, the profit that I get out of the system. So I can do damage to that edge by incorporating a very aggressive trade level strategy that would cause me to trade some trades larger than others. Overall, you could say I would have made money that year, but because I used current AUM, I randomly sized the last months or 2 months of trades much larger than the first 2 months of trades. And even though I broke even on those trades, ended up losing 50 ATRs more because of the timing of when I put those on. And so I want to minimize anything that can kind of do a bit of damage to my edge. So if my AUM doesn't change, let's just say hypothetically, my AUM doesn't change for a few years, like currently, I have 3 trade levels. I have a trade level for trades done in 2020. I still have some of them on. I have a trade level for trades done in 2021. And I have a third one of trades done in 2022. And so I'm not screwing around with those trades. I'm not truing them up based upon AUM. I'm totally fine handling all those 3 years worth of trades a bit differently and not letting it screw with my edge. Even though, given what I just said, it can still do it. It's still somewhat of a dilemma to have to make money and have to incorporate some of that profit into your trading. But like I said, you want to do it in as minimally, as conservatively as possible. Everything we're doing, we don't want it we prefer that it not have to interfere with our true edge, which is that 5,000 trade sample size.
Yes, I fully agree with this, and I want to say that it's very important to be very cautious when we are talking about our risk management. When we are making risk management decisions, we must have really a big back test, a big sample size, and so on and so forth, and we'll be very cautious.
Oh yeah, and I was just going to comment on what Alp said. I really like. I think it's really interesting the way he trades short term. I'm not sure if it's because it makes sense to me or because I've tried other ways of short term and it hasn't worked. But I do think looking at these bars and breakouts, it is very intriguing. And I do think, though, that logically, the longer term you trade, the more this trade level difference will become something that you're going to concentrate on. You're going to be very concerned about it. Look, if you're trading short term, your closed equity and your total equity can be very similar, very, very similar. You're continuing to get out of trades all the time, and you're booking this P&L. So it's not like, and I think when I traded 20-day breakouts, I never even thought of this. I think I understood the philosophy behind it, but it was only when we started trading much, much longer term breakouts that we were trying to understand exactly how we needed to change that trade level calculation and preserve that total trade equity. And ironically, I just wanted to mention one more time that ironically, by focusing on this trade level and how to properly handle it by looking at close realized profit, the realized balance, you are allowing the system to optimally handle the open trades because they're handling them the way the back test said that you should handle them in this perfect way and not having to scramble to preserve capital and to vol manage or correlation manage or just get out of positions because you're losing so much money. And that is going to be exacerbated by sizing trades based on AUM. And then how difficult is it? Can you imagine? I cannot imagine anything more difficult than putting into your head and into your clients' heads this whole idea that our benchmark is our recent all-time high. That's what you need to be concerned with. This recent all-time high that we had, that was our money. We wanted it. We liked it. We spent it. It is so important. Fuck this whole idea of you doing the right thing and following these systems and caring about sample size. I am concerned about that total equity. What are you going to do? They're in a no-win situation. And I'm sitting back and preserving realized profit. And at the same time, ironically, making more money, doing it more robustly because I'm allowed to follow the system. And I don't have to scramble because I haven't put myself in a situation which is impossible. Well, not to some people, but I think for the majority of us, it's impossible to say, hey, go back and look at that all-time high. You need to do something to minimize the drawdown from that. Oh yeah, by the way, follow your system. Then the system is going to be crap. You've asked it to do too much. And it's pretending you know better, although you can't say it. Mismanaged futures can't say it. That volatility, you don't have to, you can have a situation where volatility is not necessarily indicative of your risk of fatal drawdowns, capital drawdowns, and risk of ruin.
So just just to mention, for me the most difficult part of what I'm trying to do as a trader is to be able to follow the system. Okay, I've never had more difficulty in my life than any in the trading process, because the brain would like to get into and interfere with the machine, and to be able to do nothing is the most difficult part of it. Now, when you're losing, I find it is easier to stick with the system because you're losing and that you're always hopeful. You trust your system, so everything else is going to come. But when you're winning, it gets in my humble experience in the last 2 years. I'm trading 2 years. The winning and the making money and the open profit is just more difficult psychologically. So winnings happen with a winning streak, and losing happens as a losing streak. So I figured, being humble, staying humble, and so the whole game is, to be able to reach the average value of your system. I figured so, and to be able to reach the average winning of my system, the expected value of my system. What I supposed to be doing is I need to let the machine run, and it is difficult to do that. So to be able to let the machine run, to be able in the next 10,000 trades. So if I'm taking 2,000 trades per year, next 5 years, I supposed to be going through winning streaks and losing streaks. Hooray! And I'll come to the expected value of the system. But for me, this is the most difficult part of trend trading. Just let the machine rip, stay away from it, and don't let the brain interfere with it. Thanks.
Jerry, I've been using ChatGPT a fair bit over the last few weeks, and I've just asked it to go to Niels's podcast for Simon and do a summary of the podcast, and it's just currently spitting out a summary of the podcast. I mean, this is an amazing bit of software, and it's sort of enlightened me to the full power of what it can achieve. It's just brilliant. So if you want to get a good summary of the podcast, just ask ChatGPT to do it for you.
I can't wait till I can just do research projects by looking at ChatGPT as well. I do some, find me a group of publicly traded companies that are involved in a certain business, a commodity business or something like that. But I do think it's very, very fun and interesting. And I lost my train of thought on what I was going to say in response to ALP. But anyways, no big deal. I'll remember soon.
Hope everyone's still watching Orange Juice. It's making new highs at the moment.
Yes, don't look at anything else. Just look at Orange Juice. And another thing too is I want to remind you, that I was involved in everyone's making fun of all of us who trade cocoa, and it's been going on for a while. I think Seth and some other guys on Twitter, we make fun of each other because we still trade it, and it's had like 100 losses in a row. But I have fewer losses because I have longer term systems and a longer term stop loss, but I still had the losses, and I took every breakout upside, downside, and at one point I was long one and short the other, firmly believing I was going to lose money on both, but I don't think I did. I think so. Now I'm long both, and that's right. So I doubled down in my strategy to not only not pay attention to historical performance of markets, but if at all possible, to trade every iteration of cocoa. So I trade the UK cocoa as well. So that's done.
I got to laugh, Jerry. Cocoa's such a dog of a market. I've been trading it for a long time now, and it's just lost city.
Yeah. Well, I think in system design, I think you want to do a back test. Obviously, you want to do your back test, but I think it's very helpful to go through some of the charts and see how your system has done. And I think that two very good examples of loose pants and the minimum amount of leeway you need to give these markets. I remember reading this Clinell book, Following the Trend, many years ago, and he tried to replicate how traders traded. He tried to replicate it, and it was something like a 3 ATR trailing stop. 3. God. I mean, I was just like shocked. So he went through all these famous CTAs, and I think he was settling on 3 and 4 chandelier exit, 3 to 4 ATR exit. And okay, so my answer to that, my comment to that is no. Okay, go look at Cocoa, and Cocoa had a breakout, and then it had a tremendous sell-off. I mean, maybe it went slightly negative from the entry where you gave back all of your small profits. I never blinked an eye. Your system must stay in that trade. It must. You cannot, you can only make it worse trading in markets like this. So these are good examples of something any market can do. It can go through this incredibly choppy period. When Michael Harris was doing his back tests and sharing them with us, I was just so surprised that his win percentage was in the 20s. So I don't know what was going on with that. And I'm just afraid that people sort of look at this, but the computer will tell you to be way more tolerant of your stop loss needs to be much greater than 2 or 3. So, and then when it becomes a profit, it's shocking and disappointing in order to maximize your profit in the back test, how long term you need to be. But you need to stay in trades like Coco, and you must give back all that profit. You must let it turn into a loss because your major concern always needs to be to hunt that outlier and not take small profits. And the best way to hunt the outliers is to get on them at the breakout and try your best. Be so afraid to not get out, to get out. You don't want to have to get out. We should be way more afraid of getting out than preserving the profit. It's very difficult to do. That's why it kind of works. OJ was the exact same way. It was very choppy. A year or two ago, when we first put it on, I don't even know. I look at the OJ chart every day, and I really can't remember when I went long. But it was at some major breakout, and then it was so choppy. The market gave you every ability to get out and take that small loss. Too small. It's not a small loss. It's an optimal loss. And then it goes right back to the highs shortly thereafter. And you have to resize it. Now the ATR is greater. Now you have on a smaller position. Oh my gosh, there's reasons. There's all these reasons that the computer says trade long term. But look at all the profit I'm going to give back. Trade long term.
Jerry, speaking about Andrew Sclenow and his replicators, do we know how Andrew De Beer's gone this month?
Andrew's performance is readily available every day, every second of the day during business hours because it's an ETF. And I know Andrew hasn't done well. We mentioned at the beginning of this Spaces that some of the numbers that you were quoting came from those same SocGen CTAs. So obviously Andrew hasn't done well because they're not doing well. And then Niels says almost every week that he's underperforming. DBMF is underperforming the SocGen index, which is going to occur. And obviously he's overperforming, underperforms. He hopes to overperform by the amount of the fees, but he can't, pinpoint that all the time. I do think that one of the things that I said, I kind of sobered up a little bit, and I said, "Oh yeah, I guess I do think it's a problem if by trading 14 markets, you're not taking small bets on all 14, so that can be an issue." And then I think Niels has been saying that when the markets are trendy and smooth and everything works well, he should be assumed to do well. But now that the markets are choppy and we're giving back profits, maybe it should be assumed he won't do it, so won't have such an easy time. I don't know about that. I'm not sure how much he's underperforming, but underperforming by a couple percent can be a lot in some, to some people. But I basically haven't bothered to look at it. I know where that information resides. I just haven't looked at it.
I have,
Yeah, and
I have some numbers on that.
he has exposure in only 14 markets, and most of them are in the financial sector. He has only oil and gold for commodities, no short in the grains, no long in the cocoa or OJ or sugar, none of that. So it makes sense that he performed better than the index last year because the rates were doing what they were doing, and it makes sense that he's underperforming now because the rates are doing what they're doing.
He's actually not that much underperforming, I think. Just looking at the numbers, he's down 11% month to date, and down I think 27% from his high. The high of the ETF was $35, and it's now at 25.70. So when you take 25.70 divided by 35 minus one, that's a 27% drawdown, which I guess is a bit higher than the average CTA drawdown. It's probably higher than the drawdown of the CTA index. So actually, let me look at that. That's interesting.
Moritz, does it say what his capital flow is as far as money coming in?
You can. I can send you a chart on that. A friend of mine sent me a Bloomberg graphic on this, where I don't have a Bloomberg terminal anymore, but there you can see the capital flow, and essentially what my friend told me. Most of the people that have invested in DBMF are now underwater because the flows happened toward the highs, right? As we all know they do. Same thing over and over again. So yeah, I think most investors are underwater. But let me just look at the drawdown of the CTA index. You guys keep talking. I probably need a minute to do that.
And just got to remember now that this replication is done by smart people, sophisticated quants probably. Andrew has a staff that developed and has back tested this, and basically, the punchline is that 14 was the optimal number. It's really nice that it's the very liquid markets, and so that's what they did. They did what you and I did. They followed the back test, and he has been admitted, and he's talked about on podcasts, etc. There has been times where they had no they had no market for what was trending. There was a major trend going on somewhere, and they basically couldn't. But if you look at all the data, it is basically saying that they can get by with these 14. I personally, I'd add the soybeans and the wheat or the corn, and maybe I don't know. But and another thing too is that because he's replicating CTAs that vol manage and correlation manage, that don't rely upon an OJ outlier. If they had OJ, it would be a quarter of the position, and it would have been a quarter of my position for a long time. So they get rid of the outliers. What they want is broad movements in major sectors. All the bonds go down, all the currencies go down, all the stocks go up, all the commodities go up, and that's what they've done. And he can't replicate. You would have to trade all the markets in order to replicate someone who was going to make all their money on 5% of their trades every year due to canola and due to rapeseed and OJ and Moderna and Tesla. But that's not what he's replicating. They're making it easy for him. Go ahead, Moritz.
I got the numbers. So the drawdown from the high for the CTA index, not the trend index, the CTA index, which is the one that's relevant for Andrew. From the high, it's 11.4%. And as of the 22nd of March, so that's 2 days ago, month to date, that index is down 6.3%, up 2.1% in Feb, down 8 basis points in January. So, that is not too much of an issue. But so the DBMF is is down quite a bit more. DBMF is down 27% from the high, right? As opposed to the 11.4% four that I've just mentioned for the CTA index. So that is a decoupling.
Among the other things that we discussed about where it could go wrong and why it could decouple, the most obvious reason for decoupling for this year is that the intensity and quickness of moves in the major sectors have far outpaced history over which they have done the back tests, in which they thought it's sufficient to adjust once a week and with 1 week delay to able to catch up without paying too much of a cost. But in rare occasions where markets do their own thing, where they do something unprecedented, or they do some things once or twice every 10 years, like this year, where bonds and stocks and like all the macro markets had big moves on a daily and a weekly basis, which are outliers in terms of daily or shorter term returns. Any fund that, for example, has stop losses or adjust to volatility will adjust immediately in real time, whereas DBMF would wait for the end of the week and then maybe for a week later to actually see the change in these positions and then make the correct estimate as to what the adjustments were made, which could also be wrong because in those chaotic times, even the index members make different adjustments. So there's a bigger bifurcation of aggregate positions for the index, and they can change very quickly because one fund reacts one way one day and then another one reacts another way the other day, and they may have a small time frame mismatch. So as markets become more chaotic shorter term, both the funds that react to this chaos react more quickly and more differently. And this bifurcates the aggregate position of the index, which makes it much harder for DBMF to estimate as to what actually is going on and what the proper positions should be. And with a delay over a week or two, that's basically like a guaranteed decoupling.
Yeah, it could all come back, right? We're not predicting anything on these markets. When you look at it intraday, it's like all people seem to be worried about Deutsche Bank and potential banking crisis and a deflationary environment, and bond yields move lower and our short bonds move against us. But hey, I'll be playing tennis in 2 hours, and maybe by the time I get off court, my portfolio's completely the other way. You just never know with these markets, and I've just completely given up on almost interpreting any of that stuff. Like you can follow the news and read the Wall Street Journal and try to understand the background and all of that, and at the end of the day, you just follow the price, and that's the best thing to do. Actually, Jerry, I was listening to the Winton podcast on TTU just this morning when I was in the car, and one thing that I remembered and actually liked that, or let me ask you guys if you like that, but I liked it when I heard it first. It's kind of like he said, trend following is actually a contrarian strategy in the sense that it gets you into these positions while everybody else, and I'm not quoting him, I don't remember exactly how I said it, but everybody else thinks that position is weird. Like, you take a short equity position where, everybody is still kind of like, oh, that's the only game in town and you have to be long equities, and, and therefore then the trend establishes itself because it, takes the time for the rest of the herd to kind of like see this and get to the other side of the narrative. And the way he presented that, I actually liked it. I thought, oh, that's interesting. I know that we do take these positions which are sometimes I wouldn't say they're counter, because to me they're not counter, but they kind of like that. They look weird. It's kind of like why would I be, I don't know, short MSCI emerging markets now, where when I read the newspaper it says the future belongs to the emerging markets and everything will be going higher. Well, who knows? Maybe not. But right now that's a contrarian position. So I actually like that. I'm not sure if you liked it, but I thought it was well presented.
Yeah, I mean, I started in the middle or towards the end when he was going on about the markets, and he was very eloquent in putting forth his opinion that the more markets are better. Because I knew that was going to be something that I was going to like, and I'd listened to it before. So I wait until the YouTube transcript comes out, then I get serious and I have to go back. And so I started just tweeting so much of what he was saying that I had to stop tweeting because it was getting stupid, or maybe it got stupid a lot sooner than that. But yeah, and I like that part as well. About the
and his point on diversification, that was great.
yeah, I mean, honestly, he's a really smart guy, and I just can't help but thinking that he's a great representative of Harding and Winton, and smart guy. And did we just love, even though the three of us, Moritz, Richard, and Jerry, we had discussed offline this central limit theorem about adding markets, and then this guy pops up and tells us exactly why the guy was wrong, and we're like, okay, good, I really like that, thank you very much. But another thing that he said is something that was disappointing because I should have said this, years ago, and he said something like, well, there's 65 to 70 classic markets, that you're talking about. You notice that it used to be classic trend following. Now they've grabbed our word classic and applied it to the markets. So I'm not classic any longer. I create classic trend following system, which they use a lot of derogatory words to describe. But now, since I trade 300 markets and 150 stocks, I guess I'm not trading the classic markets anymore. But his point was that, you can talk about these 65, 70 markets, but the problem is that it's really 8 to 10 markets because they're so correlated. All the bonds, all the stock indexes, the currencies, and I just thought that was so brilliant that you don't even have 65 markets. You have 8.
It was. This was that exactly. And I was 2 or 3 weeks ago. I was listening to this podcast with a guy from Graham Capital who actually made that point. I think it was the person from Graham saying to Niels that the diversification benefit decreases with the square root over n, with n being the number of markets that you add to the portfolio. And I just immediately, like, I'm out in the forest with a dog. And I was like, that's just mathematically wrong. He just completely missed that. That is only under the condition or subject to these markets being perfectly uncorrelated to each other at all times, which is absolutely not the case, right? Because you have that cluster of bonds and all that type of stuff. So this for us is we don't even have to do the math. We just know that, there are these clusters. And if we're adding too many bonds and interest rates together, then, there's a lot of heat in that part of the portfolio, which is why we are so keen to find stuff that doesn't look like an interest rate, that looks like canola, or like lumber, or like orange juice, or like fish, or like palm oil, or like iron ore, or like rice, or like milling wheat. That is where that mathematical equation is true. Of course, again, under the condition of, uncorrelation being persistent, which, isn't true for these markets either, but they are very much more uncorrelated than these clusters of bonds. So every incremental addition of these, you cannot move me. Adding these markets to the portfolio, do it over and over and over again. If they are different, independent, uncorrelated, you can only win. You will not make it worse. You will only make it better. And therefore, this is not, dynamic position sizes versus non-dynamic position sizing discussion. That to me is almost like, if you don't add these markets, that is just wrong. Then you're really missing something that is, I don't even have to do the math to see that.
Fully agree with this. Because these commodities, I see the evidence of this, and I learned from Niels and from Jerry, from you, more from systematic investor, that this commodity, they stabilize portfolio in every crisis environment. In every crisis, commodities have done well, and especially such commodities like really maybe palm oil, canola, and something like this. I like this very much, really. Lumber.
sorry to cut you off, Oleg. I need to run, but Richard got cut off earlier, and he was telling a fun story about ChatGPT, I think, and just when you got to the punchline, I think you got cut off. So, Richard, can you remember what you were saying, and can you take us home on this story?
Well, I'm always blown away with what ChatGPT can do. So I got it to interrogate Simon's podcast with Neil. So I just referred to the web address and I said, what did Simon mean when he said a strange confusion affects CTAs, particularly equating risk with volatility? And then it came back with a distinct summary of what Simon said, saying that Simon's point is that a CTA strategy may have periods of high volatility, but this does not necessarily make it a high risk strategy. Similarly, a strategy with low volatility may not necessarily be low risk, depending on other factors. Therefore, Simon suggests that investors should look beyond volatility alone when evaluating investment strategies, particularly in the context of CTAs. Said Simon argues that volatility alone, being not a sufficient measure, suggests that investors should consider a broader range of factors such as correlations, drawdowns, and tail risks when assessing risks. How good is that?
I mean, that is really good. And I love it so much. And I'm not fearful of it at all.
It's going to make our life easier, Jerry.
Oh my gosh. I just sit there and I watch what people do for a living and how they make their money. And then I just think about 39 years of sitting in a chair and playing fantasy sports and just hardly even watching the markets and just basically sitting around and thinking and pontificating and philosophizing on how trading works and how I should approach trading and bossing people around and how easy my life is. And so now ChatGPT is going to make it even easier. And it's definitely something I definitely deserve. I think it's wonderful. All right, this has been a good one, a great one. So a lot of fun. And thanks everybody for participating. We have a great group of people who are very smart and who tolerate dissent and like each other. And I'm just so proud to be a part of this group and so happy that everybody's here. And I just hope everybody has a good weekend and we'll pick it up next week, same time. Happy trading and follow those systems.